95% of day traders lose money. Not in bad years. Not in volatile markets. On average, across all market conditions, over time. That number comes from academic research on retail day traders in multiple markets over multiple decades, and it is remarkably consistent. The 5% who do make money are usually trading with institutional-level advantages, faster data, better software, risk management systems, that the average person starting out with a brokerage account simply doesn't have. This video is about why I don't day trade, and why the math almost certainly doesn't work in your favor either. I'm going to break down what day trading actually requires, what the research says, what it costs in ways most people don't consider, and what I do instead with my money that has produced far better results with a fraction of the time and stress. Day trading means buying and selling financial instruments, stocks, options, futures, currency, within the same trading day. You open a position, it moves, you close it before the market closes. Sometimes within minutes. Sometimes within seconds. The goal is to profit from short-term price movements. It sounds simple in theory. In practice, it requires a combination of things that almost nobody starting out has: deep knowledge of technical analysis, real-time access to level 2 order book data, fast execution software, a disciplined risk management framework, the psychological ability to take losses quickly and without emotion, and enough capital to make meaningful gains without excessive risk on each trade. The barriers to entry appear low. You can open a brokerage account and start trading tomorrow. The barriers to consistent profitability are extremely high. Most people discover this after losing meaningful money. Let's look at what the research actually says. A study of day traders on the Brazilian stock exchange found that over a 5-year period, only 1.1% of day traders consistently made money after trading costs. A study of the Taiwan futures market found that around 70% of active day traders lost money in any given 6-month period, and that pattern repeated year after year. In the US, academic research from Brad Barber and Terence O'Dean, two of the most cited researchers on investor behavior, repeatedly found that frequent traders significantly underperform buy-and-hold investors, especially after taxes and transaction costs. The platforms that make money when you trade, the brokerages, the data providers, the software companies, know these statistics very well. The business model of almost every day trading platform relies on most of its users losing money, because the platform makes money on volume and commissions, not on your returns. People who are attracted to day trading usually focus on gross gains. The person who made $10,000 trading Tesla this month. The Reddit post about a 200% return on options. What they don't show is the cost structure that erodes those gains. First, taxes. In the United States, short-term capital gains, which is what day trading profits are taxed as ordinary income. If you're in the 24% bracket, a $10,000 day trading gain costs you about $2,400 in federal taxes. Long-term capital gains, on investments held over a year, are taxed at a maximum of 20% and often at 0 or 15% for most people. Day trading systematically locks you into the highest possible tax rate on every gain. Second, transaction costs. Zero commission brokerages still make money on your trades through the bid-ask spread, the difference between the buying and selling price. On liquid stocks, this is tiny. On options, which many day traders use because of their leverage, the spread can easily cost you 1 to 3% of the position value every time you enter and exit. If you're making 10 trades a day, that's a meaningful ongoing cost before any losses. Third, data and software. Serious day traders pay for real-time level 2 data, charting platforms, and in some cases colocation services to reduce execution latency. These costs can run into hundreds or even thousands of dollars per month. A beginner without these tools is competing against people who have them. Beyond the direct financial cost, there's an opportunity cost that almost nobody calculates honestly. Day trading is a full-time job. Not a side hustle. Not something you can do in spare hours between work meetings. If you're trading seriously, you're watching screens for 6 to 8 hours a day during market hours. You're studying charts in the evening. you're reviewing your trades, tracking your performance, updating your systems. If you're doing it correctly, it consumes most of your waking hours. Now think about what those hours are worth elsewhere. If you make $50,000 per year at your current job, that's roughly $25 per hour. 8 hours of day trading per day is effectively a $200 daily cost in foregone earnings, before you've made a single trade. That's over $50,000 per year in time cost alone. A consistently profitable day trader would need to clear that baseline before they're actually making money they couldn't have made by just continuing to work. This math gets even more unfavorable when you consider the leverage of that time. An hour spent becoming better at your primary career, getting a certification, building skills, taking on a higher value project, has cumulative, compounding returns over a lifetime. An hour spent mastering candlestick patterns has an extremely narrow application. Now compare that to what the same money would do in an index fund. The S&P 500 has historically returned around 10% annually over long periods. That return requires nothing from you after the initial investment. No screen time. No emotional management. No tax optimization on each individual trade. Just patience. The person who invests $20,000 into a total market index fund and goes for a walk every day for 30 years will, according to historical data, do better than the vast majority of people who spend those same 30 years actively trading. Time is a finite resource. The hours you spend trying to beat the market have a cost, in stress, in opportunity, and in the compounding value of that time applied to your actual work or business. Understanding why day trading is appealing helps understand why it remains popular despite the statistics. The variable reward schedule is almost identical to gambling. Occasional wins, even random ones, create a psychological reinforcement loop that keeps people coming back. Losing a trade feels temporary, winning a trade feels like skill. Humans are systematically bad at distinguishing skill from luck in short time frames, especially when the feedback is immediate. Social media has made this dramatically worse. Nobody posts their account statement after a year of trading. They post the one great week. The screenshot of the $10,000 gain. The options trade that returned 400%. The failure stories, which statistically should be the overwhelming majority, are invisible. The narrative is also appealing, the idea that you can escape your job, trade from a laptop on a beach, and generate unlimited income by being smarter than other market participants. That story sells courses, books, YouTube channels, and brokerage signups. It's almost entirely fiction for people starting out. So if not day trading, what? The approach I use is one of the most boring and least exciting things in personal finance, but the historical evidence behind it is overwhelming. I invest consistently in low-cost index funds, primarily a total U.S. market fund and a total international fund, through a Roth IRA and a standard brokerage account. I do this on a fixed schedule regardless of what the market is doing. I hold for years. I don't look at daily prices. I don't try to time entry and exit points. I let compounding do the work. The evidence for this is not subtle. Jack Bogle, who created the index fund at Vanguard, demonstrated that over any 15 to 20-year period, the vast majority of actively managed funds underperform the index after fees. Individual day traders, who carry even more costs and less information than professional fund managers, do even worse. This approach doesn't make for exciting content. There's no dramatic story about a single trade that changed your financial situation. But the 10-year outcomes are dramatically better for most people than any alternative that requires daily active management. To be fair, there are narrow situations where active trading isn't automatically a bad idea. If you genuinely enjoy it as a hobby and you're treating the money you allocate to it the same way someone treats money spent on entertainment, knowing you might lose it and not depending on it for financial outcomes, that's a rational choice. If you have institutional-level tools, training, and access to information that most retail traders don't, you might be in the small minority where it's viable. But that's not the situation for anyone starting out. And if you're using relatively simple, evidence-based strategies, like systematic value investing based on fundamentals, not chart patterns. That's a different thing from intraday speculation. Some of the academic research suggests certain quantitative approaches can generate marginal edge over long periods. But those are multi-year strategies, not day trading. The key question: are you doing this because the math actually works in your favor, or because the story is compelling? Most people who answer honestly find the story is the main draw, and that alone is a reason to proceed with extreme caution. Any investment whose main selling point is narrative rather than evidence-backed expected return deserves skepticism proportional to the excitement it generates. Here's the summary. Day trading requires full-time attention and significant expertise to execute correctly, produces the highest possible tax rate on gains because all profits count as ordinary income, carries ongoing costs through bid-ask spreads and data subscriptions, and statistically results in losses for 95% of participants even before those costs are accounted for. The platform's selling you into a profit from your trading volume, not your returns. What works instead? Systematic, low-cost index fund investing through tax-advantaged accounts, held for long periods, requiring almost no active time or attention. If you want to understand exactly which accounts give you the best tax advantages for long-term investing, I covered Roth versus traditional IRA in detail in my video Roth IRA versus traditional IRA, which one actually wins? I'll link it at the end. Subscribe for more personal finance content that skips the story and focuses on what actually works. I'll see you in the next one.